Welcome back to the What's More podcast. You're dialed in for episode 186, and I'm your host, Quentin Harris. And as promised on this episode, I wanted to take some time to talk about the spread, or the space between, if you may, between the 10-year and 30-year fix. You know, we had a big week last week. I mean, we had a lot of good signs point towards, some positivity, even though the Fed didn't move. We talked about why we thought they stalled, or maybe they were divided or split, or whatever it is you want to call it in that last episode. But today I want to talk about what's going on in the spread, and really that space between, if you may, between the 10-year and the 30-year fix. So let me start with a couple of things. If you're new to the show and you haven't heard us talk about this, the 10-year Treasury, it's the mover in the market. It really does set the standard for a 30-year fixed rate mortgage. And obviously, we're in the real estate business, we're in the lending business, and we talk to a lot of people pretty much every day about what are rates going to be? When are they going to come down? And, you can forecast all you want to, and then you need to throw that forecast away, update it again the next day. It's been a growing trend where we've been humbled since 2022 and 23 going into the market that we're in now in 2024. But we are seeing the light at the end of the tunnel. The September cut is near. We know it's going to happen, pending all other indicators don't get worse going into the month of August, which all signs point towards why would they? We're going to see that rate cut. And the pivotal question is 50 or 25. But before then, I want to talk about something that we've really been discussing for the last 8 months on the show. The notion that it will not take a Federal Reserve rate cut to lower interest rates. Oftentimes, the media likes to portray that what the Federal Reserve does to the Fed funds rate manipulates and changes and alters the long-term 30-year fixed rate. Now, while there is some impact on that because of the tightening cycle, the real impact takes place at the 10-year Treasury and the desired yield of the 10-year Treasury. And so what I want to focus in on this episode today is, hey, listen, why I think interest rates are going to come down between now and the next Fed rate meeting, in September, not really a rate meeting, open market committee meeting, but I call it the rate meeting because that's really what it's all about when it comes to the general public, but why I think those rates will come down regardless of that date and what they do. Because I think the market's already baked in this cut. It's just a matter of, is it a quarter or is it 50 basis points? And we talked about in the last episode what makes that needle move. But today I want to talk about why that's going to happen. So let's get right to it. So to start, if you're not a part of our YouTube channel, go subscribe. Please go to What's Your One More with the number one, because I'm going to be very chart heavy in this episode. And I need to be for you to understand the logic of what we've been talking about over the last 8 months and why what we're starting to see happen based on what we said would happen 8 months ago. And so what we're looking at, and I'm going to start with a simple chart from the Federal Reserve that shows the difference between the 10-year note, or a 10-year basically note, and the 30-year fixed rate term. Now, there's a difference. So, for example, today as I'm talking, the 10-year Treasury is at 3.98. And today is currently Thursday. It is August 1st. This episode's out on Wednesday, which is going to be August 7th. So, I mean, there's obviously some time lag between I'm doing this and then. So hold me to where it is right now, August 1st. It's at 3.98, right? So let's just shy of 4% on that, 4% yield on the note. So when we're looking at this, the differential in that and the 30-year fixed rate today is around 270 basis points. So you're looking at about a 6.75 interest rate right now, somewhere between 6.75 and 7%. That is abnormally high. It shouldn't be like that. And the chart that you're going to see in our YouTube channel here at What's Your One More, the first thing I want to look at is, let's go through like a historical path of what that looks like. So all the way back to 2013 moving forward, what the average would be from 2013 all the way to 2020, right before COVID, right? Because I don't want to talk about something that set the charts off. Let's go right up until before the charts got kind of, way out of whack during that time. But during a normal time before COVID, that average was about 170 basis points, meaning that whatever the Treasury was for the 10-year note, you could add 1.7 to it, and that would determine to the nearest eighth your 30-year fixed rate mortgage. So if you had a 3% Treasury, you had 1.7, that's 4.7% interest rate on a 4.75% interest rate on a 30-year note. It's that simple of math. Now, there are things that fluctuate that daily, but that is the range, and that should always be the given range. Well, we're at 2.7 right now, 270 basis points. So you could argue, based on what we're looking at here, that that's inflated by 100 basis points, meaning that we have rates that are way higher than what we should be seeing at a note rate of 3.98 on the 10-year Treasury. And that is unfortunate because that is impacting the affordability of the next home buyer, or a person that's wanting to refinance their home, or a person that's looking to sell and then go buy, because we know sellers are buyers. And so for the most part, this is causing a heavy drain on the mortgage and real estate industry. So the question is, why does that happen? Why did we get there? Well, that differential started to really peak after the banking crisis that happened with SVB, Signature, and eventually, a couple of other regional banks to follow there. That's what led to that uncertainty in the market, that rise and that spread getting higher. And so that hasn't gone away. It's still lingering. It's there. The reality is it shouldn't be there. And so it started to come down a little bit. The spreads are getting slightly better, right? Because if I go to a chart that we have here, and I'm going to pull this one up as well, which measures essentially the spreads from 2022 to 2023 to 2024. If you were to look at where we were in 2023 and 2024, we literally in 2023 were about 310 at this time last year. Or this time last year, we were at 310 basis point spread. So it is better, right? It went from 310 to 270. It's getting better. It's just not evaporating, right? It's a slow deterioration getting back to what it should be. And I think what happened last week with the Federal Reserve, this was a big deal. This was a big deal because we got headwind of what's coming, some smoke signals, if you may. And I think that's going to cause some more certainty to come back into the market. And I think because of that certainty, that's when you start to see this number go from 270, right, down to 250, and then from 250 down to 225. And where I'm going with this is that over the course of the next 6 weeks, we could see a significant drop in this spread. And that significant drop goes directly into the mortgage rates, and it goes directly down to the consumer. And that's a win that we've needed for quite some time, because honestly, we haven't gotten many wins over the course of the last 24 months. What's interesting to me, as I pull up this chart here, if you take a look at where we were in really February, March of this year, earlier this year, as I'm looking at this chart here, what's important about that is that we had already broke that four on that 10-year note, and we saw significant relief. If you went back and tracked 2024, March was the most productive month of the year, in 2024. It was the most productive in the form of real estate transactions. The reason being is that we got that glimpse of relief, and we got a huge win in the rate side of things. We got that needle back down into the sixes. There was a really, really good uptick of business. And that is a point, a notion to me that that's all it's going to take to get essentially the market to move again. A couple of episodes, we talked about the money pipeline. And if you did get a chance to turn into that, the new money pipeline is loans that were originated between Q4 of 22 and then Q2 of 24, but to the tune of about $2.7 trillion. And those loans range anywhere from 6.25% to almost 8% interest rate. Telling me that in March, we saw some of those loans refinance. We also saw a lot of people jump into the purchase market and said, hey, I've been waiting for this number. This is in my affordability range. I'm going to capitalize on it. It won't take much for that to happen again. And quite frankly, where we are right now at 3.98 on this Treasury as I talk right now, if you were to take the normal range, now this is the one that blows my mind. If you were to take the normal range that I was talking about earlier in the show of the 2013 to 2000 early 20, January 20 range, we would be in the 5.875 30-year fixed rate mortgage. Think about what that would do right now. If we didn't have any of this nonsense of uncertainty layers added on to what's in the market right now and kind of causing this inflated number of mortgage interest rates, if that uncertainty was removed, if that extra 100 basis points wasn't sitting there, we would be at a 5.875. That's what type of market we're currently in right now. And we're not in crazy territory on the 10-year Treasury. We've been there before at 3.98. And what do we get? 5.875 interest rates. That's where we should be right now. So what I'm saying is, if that's where normal territory, think about what that does. Think about where we go. What type of market momentum do we see? What type of transactions do we see? What type of healthy buyers do we see come to the market? Well, we're going to see a lot of them. And more importantly, the people that are currently locked in, do they refinance and get the equity out that they've been waiting for? Do they say, I'm going to list my home now and go buy another home because in the fives makes sense to me? There's a lot of things that happen at that magic number of 5.875. And quite frankly, we should be there right now, and we're not. And the question is why? It's the uncertainty that we experienced during the banking crisis of 2023 is still looming, still lingering out there, and it needs to dissipate. And it's slowly happening, way slower than it should be. And the air needs to come out of the balloon at this point so that we can get back to normal procedures. And we're going to see it at a very slow level. Now, what could cause all 100 of that to go away, like be done? Here's the formula for it. over the course of the month of August, we need to see a good CPI reading at expectations or better, or lower than expectations, meaning it's a good reading. More importantly, the PCE data needs to come in at expectations or lower so that we have a good PCE readings. Final piece of the puzzle, and maybe based on what Jerome Powell said at the podium, the most important piece of the puzzle, the BLS job reports and the ADP job reports. Those need to come in at expectations or less. And JOLTS should come in less as well. If we see the unemployment number go up, that's the big thing. If the unemployment number goes up, all bets are off in a good way. If the unemployment number goes up, what you're going to get is that 50 basis point cut in September. You get a combination of a 50 basis point cut, good economic readings, that overlay, if you made, that uncertainty, that inflated number that's built in, that disparity is going to go away. And we're going to see a much more accurate depiction of a 30-year fixed rate than what we've seen before. If you look at the major forecasts from Fannie Mae, the MBA, Freddie Mac, they're all saying 2 additional rate cuts. There's only 3 meetings left. They're all saying, well, hey, listen, we're going to be at about 6.5 at the end of the year. That's conservatively speaking. Heck, we may be 6.5 at the start of next week. So what is the real number going to look like? Well, I think you're going to be in the upper 5s. I definitely think you're going to be hovering those low 6s because the market is starting to show signs of confidence. And as confidence enters the market, you start to see that evaporation here in that 10-year Treasury, that spread that I'm talking about. And so another thing on this chart that I wanted to kind of point out on here was this. I go back to 2019, and I'm pulling up a chart here for the 10-year Treasury. And what I'm doing is I'm saying, hey, listen, I'm looking at the history of the 10-year Treasury. If I go to August today, so today I'm recording this on August 1st. If I go to August 1st on the 10-year Treasury, the 10-year Treasury was at 1.71. 1.71, okay? The 30-year fixed rate should be somewhere with about another 170 basis points on top of that. So that would be what, like 1.341? You round up, that's 3.5, right? That's how that logic works. So let me go to the 30-year fixed rate historically. Let me go to that. I'm going to go look at it right now as we're pulling this up here, and I'm at Fred, which is the economic center from the Federal Reserve. So let's go to August 2019. A little hard to toggle back and forth there. There I am. 3.75. I said it should have been at 3.5. It's at 3.75. Now, what's interesting to me is, so you got a little bit of a spread there of about 25 basis points over, but that's a hell of a lot closer than 270 basis points. So my point is this, traditionally speaking, and that was blind math, I'm doing that blindly on the show here, that proves my point. Pre-COVID, we had a range that was much more predictable, and it was much more steady over the course of really a 7-year window. You can take this all the way back to really 1980 on this chart. But the reality is this, is that we are way over compensating for factors that have already happened in the market in basically inflating the difference between the 30-year note and the 10-year Treasury. It's getting better. It's not where it needs to be. And for those that are listening, they're like, Quentin, hey, I'm not really a numbers person. You're throwing a lot of things out there, and it's hard to keep up with this. Again, go to our YouTube channel. You'll see these charts that we're putting in there. But my point is this, if you're a prospective buyer, hey, help is on the way. If you are a homeowner looking to sell or refinance, help is on the way. You're about to get the numbers that you've been looking for. If you're a real estate agent and you've got buyers that have been sitting there and you're like, hey, listen, I'm ready to get my toe in the water. I'm ready to get in the game, but I need that rate to be in the 5.875, 6.25 range for this to make sense for me. You're pretty much about to be there. And I think you'll be there before the next Fed meeting. If you're a seller that says, listen, I need to sell, but it doesn't make sense for me to sell now. Where am I going to go? How am I going to get a payment that's in range? I know I've got this equity, but it doesn't make sense for you to take the equity out, put a down payment before. Where am I going to go? The range is coming. It is there. The sad part is that even with all this momentum, even with all of this market swing, as I look at this, we're at 397 as I'm talking here. We should be celebrating these low 6 rates right now. That's where we should be. We're not. Like, for anybody that's in the mortgage industry, you're probably going, hey, listen, why isn't this showing up today? Why can't I get these rates that we're discussing and pass it down to the consumer? It's because the market, when it comes to rates, is slow to react in a good way and quick to react in a bad way. So, hey, if things are going wrong, it's like, move the rates as fast as possible up, hedge all the risk. When things are going great, it's like, well, let's back up. Let's see if this good trend really lasts longer than, 48 hours, maybe even 72 hours. But what I would say is this, momentum is building. Tomorrow, the BLS report, as I'm recording this, Friday, the BLS report will come out. You're going to get this episode on Wednesday, so I'm flying blind here. If that BLS report comes out Now, there's a birth death rate model in there that we talked about last episode that could kind of, moogie foogie this thing up, but it's the unemployment number that matters. And if that unemployment number hits at 4.1 or higher, all bets are off. The uncertainty and the evaporation I'm talking about it'll start happening at a more rapid rate, because at that point the heat is on for the Federal Reserve. The heat is on. The pressure is there. Hey, listen, you should have cut last meeting. You didn't. So now you need to double down and be 50 basis points. The heat is on, and that's what's going to be coming. So if you're one of those people that say, listen, I'm not a numbers person, what should I be looking for? Friday morning, August 2nd. At 8:30, that BLS report will come out. By 9, all the numbers will be revealed. You're looking for one number only, unemployment. Was it 4.1 or was it higher? If it was lower, that's going to stall this process. So if it's 4%, it's going to be lower, it's going to stall it. If it's 4.1 or higher, it's going to accelerate this process. And then every Thursday, continuing claims come out at 8:30. If that number creeps to 275 or higher, that also is going to accelerate this. So we've got 4 to 5 data point sets that are going to come out between now and that next meeting. All of those can accelerate and evaporate this 100 spread that I'm talking about. And we could very easily be in the low 6s before the next Federal Reserve meeting. And then if they hit that 50 basis point button, which I think they're going to do, it'll be just enough to put us over the edge. Because you got to remember, by the time that 6 weeks gets there, that 50 basis point is already caked into the numbers here and anticipated. And all of the market is moving ready for that. Because you got to understand, the market's going to move before the Federal Reserve does, because they want to anticipate the move and they don't want to wait. The impatience of the market is always been there. So they're going to bake it in and say, listen, we already account for that. We understand. We expected that to happen. So that's why I think over the course of the next 6 weeks, they're going to be vitally important. Jobs. I can't say it enough. That's what we're going to be looking for starting tomorrow morning with the BLS report. 4.1 or higher is what we're rooting for here. Obviously, we don't want to see people unemployed, but we need the economy to rebound in certain areas, and that's very important here for what we're talking about when it comes to mortgage interest rates, as well as new homeowners and then homeowners that are looking to move and upgrade that are waiting on lower rates to come. So hopefully that time is here. Guys, if you like what you're hearing on the show, please 5-star review this podcast. Share it with a friend, family member, colleague on any platform you listen to your favorite podcast on, and tune into our YouTube episodes and our channel at What's Your One More with number 1. All charts, all graphs, all links, all data sets that we're talking about are on there. And continue with your comments. We appreciate them. We try to read all of them and definitely respond to them as well. So thanks for tuning in. We'll see you at the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so